Next type of subsidiary book is purchase return book. The purchase return book records the details of the goods returned by the buyer to the supplier. It is also known as bought return book or return outward book. Reasons for the return can be any of the following. First one is defective goods or not according to required quality, not according to description, late delivery of goods, terms and conditions may not be suitable to keep the goods, etc. You can see the format of purchase return book on your screen. Again, you will find date, particulars, debit note number, ledger folio, details, total, remarks. Now, remarks includes the reason for goods returned. Before learning more about purchase return book, let's discuss the term debit note first. It is a resource for purchase return book. It is a document or statement sent by the firm to the person to whom goods are returned or from whom an allowance is claimed. It is an intimation to the supplier that his account has been debited to the extent of value of goods returned or allowance claimed. It contains description of goods returned, name, place of supplier, etc. Now, let's come to the example of purchase return book. Enter the following transactions in the purchase return book of Hari. January 5th, return goods to Anand, 5 chairs at $200 each. Reason is not in accordance with order. Next one is on January 14th, return goods to Chandran, that is 4 chairs at $200 each and 10 tables at $350 each. The reason is inferior quality. Now, let's have the look at the solution. You will find in the particular side, first one is on January 5th, that is Anand, and 5 chairs at $200 each. The total becomes $1,000. And on January 14th, you will find Chandran, and there are 2 subheads under it, that is 4 chairs at $200 each and 10 tables at $350 each. So the detail becomes $800 and $3,500. In total, you write $4,300. And the grand total becomes $5,300. And on the remark side, we write not in accordance with order on January 5th and due to inferior quality on January 14th. And the next book in the list of subsidiary books is Sales Return Book. The Sales Return Book records the details of the goods returned to the supplier by the buyer. It is also known as Returns Inward Book. Reasons for the return can be defective goods, not according to required quality, not according to description, late delivery of goods, terms and conditions may not be suitable to keep the goods, etc. As we discussed before, debit note is the resource for purchase return book. And on the other hand, credit note is the resource for sales return book. Before going into the detail of sales return book, let's discuss the term credit note. It is a document or statement sent by the firm to its customer who returned the goods or claimed an allowance from the firm. It is intimation to the customer that his account has been credited to the extent of value of goods returned or allowance claimed. It contains description of goods returned, name, place of supplier, etc. On your screen, you can see the format of sales return book. You can find the format is similar to the purchase returns book, but the basic difference is there we mentioned debit note number, and in this case we will mention credit note number. In remarks column, we will record the reason for return of goods. Let's take an example. Enter the following transactions in the returns inward book. April 6th, returned by Shankar 30 shirts, each costing $150 due to inferior quality. April 8th, Amar tailors returned 10 Baba suits, each costing $100 on account of being not in accordance with their order. On 21st April, TN stores returned 12 salwar sets, each costing $200, being not in accordance with their order. Now let's have a look at the solution. Very first transaction took place on 6th of April, so in date column we will mention 6th of April 2003. We will write Shankar and 30 shirts at $150, so the details becomes $4,500. Next is 8th April, Amar Tailors, 10 Baba suits at $100 each, so the total becomes $1,000. And lastly, on 21st of April, TN Stores, 12 Salwar sets at $200 each becomes $2,400. So the total becomes 4,500 plus 1,000 plus 2,400, that is equal to $7,900. And you may find that on the right side there are the remarks, that is inferior quality, not accordance with the order, and again not accordance with the order. As we have discussed the meaning of debit note and credit note, now let's discuss its difference. Now, let's have a look at the difference between debit note and credit note. And the first point is, debit note is prepared and sent by a customer to the supplier. And credit note is prepared and sent by the supplier to its customer. Debit note serves as an intimation for goods returned, and credit note serves as an acknowledgement for goods received back. Accounting entry intimation. Debit note intimates supplier that his account has been debited with the amount shown. And credit note intimates customer that his account has been credited with the amount shown. Next basis of difference is follow-up. Usually, a debit note does not follow a credit note, but a credit note generally follows a debit note. And the last basis is basis for entries. Debit note is the basis for making entry in purchase return book, and credit note is the basis for making entry in sales return book. Now, moving on to the meaning of bills receivable and bills payable books. Bills receivable book records the bills drawn and received back with acceptance of a debtor. And bills payable book records the acceptances given by the debtors. Now, moving on to the meaning of journal proper, it is used for making the original record of such transactions for which no special journal has been kept in the business. The usual entries that are put through this journal are as under: opening entries, closing entries, adjusting entries, transfer entries, rectifying entries, miscellaneous entries, credit purchases and credit sales of asset which cannot be recorded through purchases or sales book, endorsement, renewal, dishonor of bill of exchange which cannot be recorded through bills book, and the last one is other adjustments like interest on capital and loan, bad debts, reserves, etc. Thank you.